Hi, welcome back. In this episode, we are going to discuss everything audit. Everything that you could possibly want to know. A lot of people think that audits are very scary, and that's the truth. I mean, tax is already a difficult subject. Now you're being challenged on it, and the IRS has incredible power to take your home, to garnish your wages, to access your bank accounts in some instances if you don't pay. So now they're coming after you and they're saying you owe us money that you thought you had already disclosed or that you had done your tax return correctly, and now you're having the IRS come at you and say, nope, you owe us more. So today we are going to talk about your chances of being audited, how you're chosen for an audit, the types of audits, and then what happens after an audit. All right, so what are your chances of being audited? Well, it's actually quite low. For original returns, your chance of audit is actually between 2 and 4%. This is due to budgetary limitations, so only a small number of tax returns are audited per year. In fact, in 2014, it was the lowest percentage of audits since 2005, being a percentage of 0.86%. Don't we all wish it was 2014 again? So how are you audited? How do they come up with the fact that you should be the one who is audited? Well, that's through the discriminant function, or the DIF. It compares your data with that of others. For example, itemized deductions compared to income. Other factors that the IRS has disclosed that they look at when they are using their discriminant function include high-income individuals, self-employed individuals with high income and lots of deductions, cash-based businesses like cafes, because it's hard to disclose what is actually being collected if it's all in cash instead of credit card transactions. Inconsistency with information returns. So those W-2s and those 1099s, those are to help in reporting accurate information from your employers, as well as large itemized deductions, filing a refund claim, game shows, lawsuits, other public information. So for example, 2006 first season Survivor winner Richard Hatch, he didn't report his game show winnings on his tax return. He was then prosecuted for criminal tax evasion. Additionally, the type of entity. Each year, the IRS will announce the targeted audit entity for that year. A lot of times it's LLCs. And then there are others. Industries, particular industries will be audited. Tax preparers, if they're not doing it right or they have a scheme that they've been involved in, they'll also get all of their clients audited. But on the other side, a lot of times, large publicly held companies are audited frequently, just because they're large companies and they want to make sure that the shareholders, the investors, are being protected. This is computer-based, so all returns are also checked for calculation errors. Going back to matching errors for W-2s and 1099s, you always want to include data, even if it is erroneous. So sometimes people will deliver a W-2 that's incorrect. Even if it's incorrect, you want to put it on your tax return and then take it off with an explanation as to why you did not report the same amount of income that was disclosed on your W-2. And the best thing that a preparer can do to avoid audits is to audit the face of the document. Include enough information that in the event that this is picked up by the DIF, the person who then looks at the tax return after it's been flagged will then look at the tax return itself, be able to identify what the issue is, and then have enough information that they can then make the decision as to whether or not to move forward with an audit. All right, so types of audits. The first thing that we need to talk about is scope and nature. So before we get into what type of audit, every single audit is going to disclose what the scope of the audit is. It'll be set out in the initial letter. No fishing games are allowed. So the IRS can't just audit anybody that they want to see if maybe they can make a little bit of extra money for their quotas. No, there are no fishing games. It's a part of the Taxpayer Bill of Rights. Also, they can audit you based off of cost of living. Cost of living audits are sometimes initiated by special agents. I mean, this one special agent who stated that if he was driving on the freeway and there was somebody younger than him who owned a more expensive car, he would write down their license plate and look up what their income was and whether or not they could actually afford that car based off of what that person had initially reported on their tax return. In these audits, sometimes there are special agents who will follow the taxpayer around to see where they live, where they eat, where they go, where they spend their money. You have got to be able to prove your deposits, and in these cost of living audits, this is where the taxpayer must prove where the amount of income actually came from and where their expenses actually came from. So the first type of audit is a correspondence audit. This is regarding very simple issues, and the IRS typically requests documentation so that they can then prove what's on the face of that tax return. The next type of audit is an office examination. It's a little bit more complicated. They want to talk to the taxpayer, and so it's conducted at the local IRS office. The next is a field examination. This is where these are complicated businesses or individuals with complicated assets and income streams. This is conducted at the taxpayer's place of business where the records are kept, and it may be transferred to your attorney or accountant's office. During the audit, the IRS will propose to give you an extension on the statute of limitations. You can either agree to this, but if you don't, they will assess a deficiency. If a special agent accompanies or takes over a revenue agent's role in the audit, the IRS then suspects criminal activity. Revenue agents review the tax returns. They're the ones typically responsible for audits. Special agents are involved in the criminal division of the IRS. And so in the event that you get a special agent, at that point you want to take appropriate action and retain counsel. Because in an audit, you can represent yourself, or you can have your CPA represent you, or you can have an attorney represent you. And so in the event, though, that it becomes criminal, you want to have your attorney on your side because there are some additional legal factors that you want to make sure are taken into consideration. All right, what happens after the audit? Well, the IRS will then issue a revenue agent report. It will describe if the result was a deficiency, if the result is a refund, or no change is declared because the tax as identified on the tax return was correct. You, as the taxpayer, can sign the agreement or you can dispute the agreement. If you dispute the agreement, a 30-day letter will be issued. This states that you have the right to appeal or to pay the tax, and if you decide to dispute and continue forward, you can request an appeals conference. At an appeals conference, generally, this is a great place to be because the IRS wants to work with you. They're looking at the next step because the first is an audit, the second is an appeals conference, and the third is litigation. And so if litigation doesn't look like it's going to pan out well, they're going to want to work with you. They don't want to go to that extra cost, send out those additional resources because the IRS litigation department is incredibly busy. They have too much work. And so if they don't think they're going to win on this, they don't want to move forward. However, if they are not budging on this, they're not willing to work with you, it may be because the issue that they are dealing with on your appeal is one of the issues that the National Office of the IRS has listed this year as one of the issues that they would like to litigate. The tax code is rife with gray areas. The law is never black and white. There are a lot of times it is, but in a lot of times it's not. And so there are these gray areas where they want a specific fact pattern to be able to take to court to address an issue that they want an answer to. And so if they're not willing to work with you, you may have one of those particular topics. Otherwise, a lot of times they are willing to settle for a percentage of the tax due on one or more of the issues. So it can either be a really good thing or at least you know where you stand in the scheme of litigation. Once the appeals conference has been concluded and whether or not they are willing to budge on it, or they have assessed a different type of tax, or whatever the case may be, refund, deficiency, etc., you can either agree, or the IRS will then issue a 90-day letter stating you can pay the tax, or they will move forward in the appeals process and it needs to go to litigation. The 90-day letter is also called the statutory notice of deficiency. If you choose not to pay the tax at that point, it then will go to litigation. We'll talk about litigation and the process of taking a tax case through court in the next episodes, so stick with us. If you liked this episode, give it a thumbs up and subscribe below. If you have any questions, feel free to leave a comment in the comment box below or send an email to centerfortaxstudies@gmail.com. Thanks for watching, and I hope to see you soon.